Good morning, good afternoon, good evening. My name is Mark Plant. I'm a Senior Policy Fellow, and it's my pleasure to welcome you to the Virtual Center for Global Development. With the allocation of $650 billion worth of SDRs that took place on August 23rd, global policy attention has shifted to the best way to use those SDRs. While the new SDR allocation gives each country more monetary and fiscal room to maneuver, there's broad recognition that there will be a benefit to recycle or channel the new SDRs of advanced countries to more vulnerable low and middle income countries. In this context, the IMF is considering establishing another trust, tentatively named the Resilience and Sustainability Trust, or RST, that can be accessed by vulnerable middle income countries as well as low income countries, and will provide financing for a broader set of issues related to transition from the pandemic into a more sustainable and equitable global economy. Today, we'd like to examine the challenges and opportunities ahead for the establishment of an RST as a mechanism to reallocate new SDRs. We hope to discuss what an RST might look like, what gaps it might fill in the international financial architecture, and what the challenges would be in setting it up. In thinking about the RST, it's critical to keep in mind the 3 steps to make SDRs an effective tool in recovery and transition. The first is the allocation. That's done. The second is the reallocation or recycling. That's the challenge before us. But the third step, and the most important for success of the endeavor, is getting the recycled SDRs to the countries that need them. So we need to set our sights on clearly establishing an RST that serves country needs while ensuring the global stewardship of the recycled SDRs. With that brief introduction, let me introduce the members of our panel. John Hicklin is a non-resident fellow at CGD. He had a long career at the IMF and held various senior positions in the IMF's Policy Review Department and the Independent Evaluation Office. Uma Ramakrishnan is a Deputy Director in the Strategy, Policy and Review Department of the IMF, and she's spearheading the fund's efforts on the allocation and use of SDRs. Rodrigo Cubero, another IMF alumnus, is now the Governor of the Central Bank of Costa Rica. Mikael Ayashi is the head of International Financial Systems and Summit Preparations in the French Ministry of Economy and Finance. He's had a long career in finance in both the public and private sectors. And Meg Lunziger is a public policy fellow at the Woodrow Wilson International Center for Scholars, and represented the United States on the IMF's executive board and was a high-level official in the US Treasury. Before I give the floor to panelists, I'd like to remind you that we will be taking questions from the audience at the end of their interventions. You can send us questions in 3 different ways. You can tweet us at CGDev or hashtag CGDTalks. By email, you can send an email to events@cgdev.org, or you can use the comments and discussion tool on the YouTube channel that you're watching on. So now let's get started. I'll give each panel 10 minutes for their introductory remarks. Let's turn first to John Hicklin. John, can you please outline the vision you have for the RST and the international framework for accelerating climate finance and the major obstacles to setting it up?
Well, thank you, Mark, and it's good to see everyone here. I will lay out the case that the IMF should set up a new resilience trust without delay. Certainly the time for this initiative is now, as Mark has just mentioned. But to those who say that, well, this is just a transfer of the SDRs from those with an excess of them to those who need them, unfortunately, the story is much more complicated. The IMF board and staff first need to navigate many legal, policy and political hurdles, as I'm sure we shall also hear from Uma. So on slide 1, I set out to the outline of what I'd like to say. First, what the proposal involves. What the proposal involves. Secondly, how this particular design can address the many demands placed upon it. And finally, the next steps. What is needed now at the meetings this week and over the next month or so, given the magnitude of the task we are facing. So in the next slide, I asked the question, so what does this proposal involve? First, the basic elements of Resilience Trust are straightforward. It's similar in structure to the Poverty Reduction and Growth Trust, the PRGT, the IMF already manages, but with some important differences. The source of funds would be at least the $50 billion worth of SDRs lent by advanced countries, the eligible recipients would be a broader group than those now PRGT eligible, covering low and middle income countries in support of policy actions to make their economies more resilient. The terms of the loan would also differ from the PRGT. There would be longer terms, say 15 years, with low income countries paying less, essentially zero interest, than middle income countries. The second element is the IMF Executive Board would establish the policy framework and approve loans for eligible countries that qualify. Here lie many of the aspects that distinguish the new trust from the PRGT or from regular IMF lending. Amongst them, the concept of resilience that defines the purpose of the trust. The focus, in my view, would be on tackling climate change, reduced biodiversity and desertification. The nature of the balance of payments need, the nature of the policies of the recipient country would be expected to take. These elements are set out in more detail in the background note, and I'd like to focus here on another aspect of the policy framework in the next slide. The integration of this loan facility into the much broader fabric, or quilt as I call it, of international cooperation. The trust should be seen not just as a limited transfer from advanced to developing countries, but part of a truly global effort, hence the global in the label we dubbed for this trust. After all, the largest economies will be responsible not only for the source of most public and private financing for global resilience, but also the lion's share of the global decarbonization efforts, for example. The spillover of their actions or inactions will affect the speed of adjustment for developing countries and therefore the credit risk associated with lending to them. One additional point, while smaller developing countries will contribute relatively little to global emissions mitigation, many have a significant role in preserving biodiversity and protecting land from desert encroachment. Supporting these efforts helps those countries, but also the global public good. So to make the trust fully effective, we therefore propose several parallel initiatives. Each country, from the largest to the smallest, would prepare a national resilience plan, essentially a policy statement outlining the macroeconomic impact of climate change, reduced biodiversity and desertification, the policy response, including both mitigation and adaptation. The policy statement would be consistent with the country's NDCs, the nationally determined contributions and national adaptation plans for the UN process. They were discussed as part of the annual consultations, the Article 4 with the IMF, and be made public, allowing civil society engagement and accountability for actions. And finally, they would form the basis of a request for support from the trust. The IMF's unique global reach would allow it to analyze the aggregate consistency of countries' policy statements and better understand the spillovers affecting others, including those seeking financial support. And secondly, the policy statements would also provide a link to the work of others. They would incorporate the macroeconomic policy implications of the parallel initiatives, which are crucial, of the World Bank and other MDBs and donors, including the enormous agenda ahead to help countries restructure and refinance major sectors of economies. Enhanced cooperation should also lead to more in-depth joint assessments. And finally, there would be a series of resilience financing conferences of donors and private investors convened by the bank and the fund for those countries accessing the Resilience Trust and the parallel MDB programs. In this way, the trust could help catalyze the needed official and private financing that will run into the trillions of dollars. The IMF's role will be to signal the country's policies that give the right incentives for such investment. On the next slide, we ask the question, well, how does this model satisfy the various concerns and constraints? First, it maintains the reserve asset nature of SDRs. Many creditors insist on this requirement in trying to channel SDRs for long-term borrowing. How does the trust do it? As with the PRGT, to protect against liquidity and credit risks, the on-lending from credit and recipient countries through the new trust would be complemented with an encashment scheme in case the creditor needed to withdraw SDRs quickly, as well as subsidy and reserve accounts. These new accounts would require additional hard currency contributions from creditors in addition to the SDRs they would lend. Second, the new trust can be established quickly and with a tried and tested governance structure at the IMF. It requires broad support to make it, very broad support to make it viable, though technically I understand not a special majority vote at the board. The conditionality, safeguards, and publication policies of the IMF give confidence in the transparency of the trust's operations and further help to reduce credit risk. Third, and importantly, the design can deal with conflicting concerns that the trust would be too easy to access or too hard. It balances, on the one hand, the desire of creditors who wish to prevent facility shopping, with, on the other hand, the preference of borrowers who are wary of too stringent conditions and of the stigma of going to the IMF. How to strike this balance? By finding the Goldilocks amount of conditionality, by ensuring that countries with policy-induced balance of payments problems must seek regular IMF financing. The additional access to the trust resources can be seen as a positive development. In principle, therefore, and logically, the trust could be accessed on its own by countries with a sound macroeconomic position and no immediate balance of payments need other than that induced by the policy measures to build resilience. Moreover, the limited size of the trust suggests low access for each country, and conditionality should be commensurately moderate. And fourth, the proposal should reassure those who prefer a limited role for the IMF. As described, it envisages parallel roles for many public institutions in the private sector. But more than that, both the IMF and the bank need to be fully engaged to meet their respective responsibilities and cooperate with each other. Let us remind ourselves as we delve into these arcane topics of SDRs, trust funds, the complex process of initiating change at the IMF, why we're doing this. We collectively face the greatest global challenge of the generation, and as in the chart illustrates, that if emissions are now close to the point where keeping the global temperature to 1.5 degrees becomes out of reach, either the world will rapidly, very rapidly change course and then meet its aspirations for net zero by mid-century, or it will not. In either case, the shock to the present economic structure is immense and will be long-lasting, and in the latter case, potentially catastrophic. The trust is therefore an initiative that can help spur action of profound importance, as well as catalyze the much larger financing required to support it. So finally, next steps and deliverables this year. Time is short and these upcoming meetings must be used. At the G20 and annual meetings, the IMF should be tasked to do two things: create the new trust and, I would argue, develop a pilot for these policy statements, the national resilience plans. The government should begin to pledge the SDRs that will be rechanneled to meet the 50 billion minimum, together with pledges for the related contributions. And at COP26, government should finalize their pledges to fully fund the trust and volunteer to be one of the group of countries that would participate in a pilot scheme for the policy statements. On that occasion, several eligible countries could prepare to step forward to present their statement and request policy support from the trust. And it would also be the occasion to announce the first resilience financing conference of both official and private investors. As chairs, the UK and Italy have key roles in lining up pledges of volunteers. As other institutions pursue complementary initiatives, the IMF can play a leadership role in threading the needle to make the new trust a reality. Thank you.
Okay, it seems like Mark may have some technical issues there. So let me jump in. Thank you, John. And you have laid out the outline for the design of what we are envisaging in the RST. And so let me dive right into how we are thinking about the Resilience and Sustainability Trust. So first of all, greetings to everyone. Thank you for having me today, and it is great to be in the CGD event again. I thank the CGD for remaining engaged on this topic and providing a forum for exchanging views. In the context of the $650 billion SDR general allocation in August, Several shareholders with strong external positions have expressed their interest to voluntarily channel some of their SDRs to help poorer and vulnerable countries. And the challenge now is for us to ensure that the distribution is redirected or channeled, as we call it, to where there is greatest need. And in the last event at the CGD, I presented the three options that the IMF is considering, the three non-mutually exclusive options. One is to increase the size of the PRGT, or our concessional lending tool. The second was to create a new IMF-administered Resilience and Sustainability Trust. And the third was to channel SDRs to other prescribed holders, including entities like the World Bank. Today, I want to dive deep into the proposed Resilience and Sustainability Trust, or the RST. As background, there's a dual challenge currently facing many countries. Specifically, economic divergence is exacerbating as poorer countries are disproportionately affected by the pandemic. At the same time, many are also facing major threats to their long-term sustainability as a result of long-term challenges, including climate change. If not addressed, these vulnerabilities could jeopardize further balance of payment stability and growth in the future. Thus, even as we fight the current pandemic, we cannot lose sight of the lingering long-term risks that may set these countries further behind. And in addition to the lack of fiscal space, one key reason why these challenges are being left unaddressed is the lack of affordable long-term financing. And in that context, SDR channeling creates an opportunity to facilitate such structural reforms at a time when financing is scarce and policy space very constrained for many countries. So creating a new trust in the IMF requires that it be consistent with the purposes of the IMF, meaning that it must address immediate or potential or prospective balance of payments financing needs. So in line with that purpose, one way to think about the proposed RST is as a third leg of IMF lending to provide longer-term financing for policy reforms that might help build economic resilience and sustainability. If these reforms are not undertaken, it could put at risk future external social and economic stability. In other words, in IMF lingo, undertaking these reforms is necessary for supporting what we call prospective BOP stability. The RST lending may also help address other more immediate BOP needs arising from these reforms. Now, lending to the RST is expected to be a part of a broader international effort to address these structural issues. This means that RST lending per se may be modest relative to the country's financing needs to address these structural issues, but we expect that it will catalyze other financing from MDBs and the private sector, much like what John said in terms of convening and catalyzing through international conferences. Let me get a little bit into the design features that we envisage for the RST. I would note at the outset that this is preliminary thinking. This has not been fully endorsed by the board yet, and the proposals are still in the stages of engagement. So what I outline are still work in progress. So jumping straight into the purposes are envisaged for the RST. The purpose of the funding would be reached by consensus across the membership. For example, climate indeed may be one, but there are several other public policy goals that may need to be considered, such as pandemic preparedness also. The eligibility and qualification for who might be able to borrow from the RST. The executive board again has to sign off on what the final eligibility perimeter might look like, but our preliminary thinking is that it could include all low-income countries which are currently eligible for our PRGT concessional lending. It could include all small island states which are vulnerable to natural disasters, and it may also include some middle-income countries that may be vulnerable. There could be different approaches on determining the eligibility for middle-income countries. It could be universal, or it could be based on some objective metrics like income and/or market access criteria. Now, the RST is envisaged to be a top-up to a regular financing or non-financing IMF-supported program. So we don't, at this point, envisage that the RST will be standalone. It will be concurrent with another IMF program. And this, we think, is necessary to provide the strong policy safeguards to ensure macroeconomic stability. The lending terms that we are thinking about. Now, the types of transformational structural reforms we are considering for the RST lending are likely to yield results only in the longer term. Thus, in our view, cheaper and longer term lending may be justified than is currently feasible in the IMF's toolkit. The current maximum maturity is 10 years in both the PRGT and the non-concessional GRA lending. The RST could go much beyond that in terms of lending term structure. Interest rates could also be lower than the current IMF lending rates, and the envisaged long-term structure could provide significant concessionality. On access, we expect the access would likely be capped at a nominal amount, and what exactly that will be a little bit of an iterative process because it also depends on the size of the trust. The exact level of access for each country that borrows from the RST would depend, like they do for other IMF lending, on various factors, including the strength of the reforms, as well as policy safeguards such as debt sustainability, the members' ability to take on more debt, their capacity to repay the fund, etc. Conditionality. John referred to Goldilocks conditionality. We'll have to discuss on what that might look like. But we do envisage that the RST would have its own conditionality pertinent to the purposes of the trust. Conditionality would cover key policy reforms that are associated with the improvements to the balance of payments, including for prospective balance of payment stability. Now, the collaboration with other NDBs we think is a critical factor. And given that the long-term challenges that the trust will seek to address, like climate change, are being addressed by several institutions, including several other IFIs, we envisage collaboration with the World Bank will be critical in particular, so that we are able to leverage the expertise and comparative advantages of the respective institutions. We would seek to achieve policy complementarity between the RST and the broader policy and financing strategy for the country for particular purposes like climate. The fund, we envisage, will remain responsible for monitoring and assessing the RST conditionality, which means there will be no what we call cross-conditionality across institutions. We are already in close collaboration and discussions with the World Bank on how to move forward on this RST to ensure that there's full buy-in from both sides. Now, the financial structure. John mentioned in the beginning that it is everything our SDR channeling is a little complicated, and the financial structure in particular is very complicated. The RST will be an IMF-administered trust with a financial structure similar to the PRGT, including on the governance and the financial architecture. We expect that there will be a multi-layered credit risk management framework with policy safeguards, such as access policies and the link to the current IMF program, adequate financial buffers, such as a reserve account like the PRGT, and possibly an additional deposit account as a second layer of financial buffer. And we would also hope that there's a supportive multilateral context, meaning a diversified base of creditors and borrowers that would ensure that the trust is sufficiently safe and liquid so that channeled SDRs are encashable and maintain the reserve asset status for creditor countries. A question that often arises in our discussions with stakeholders is, what is the value of the RST relative to what the World Bank or other NDBs might be doing already in this space? We envisage the RST to be lending into policy areas, not project lending, so that we are able to catalyze additional financing from MDBs and private sector. In this regard, I would cite as example some ongoing work by our Fiscal Affairs Department on fiscal policies for climate change adaptation that discusses how the IMF could take a leading role in supporting countries via capacity development and catalyzing financial assistance. The paper is looking into exploring how fiscal policy can facilitate efficient adaptation by providing the right incentives, investing in infrastructure, diversifying revenue sources, making financing plans resilient, promoting post-disaster preparedness, public financial management, incorporating adaptation in their frameworks, etc. Why am I saying this? I'm saying this because it is an example of how the IMF core fiscal policy is central to moving forward in climate change also. In closing, I would like to add that building consensus does take time, and creating a new trust from scratch is complicated. The design has to be attractive enough to get both borrowers and creditors equally excited about it. We have made a lot of progress, and we are optimistic that we will generate the necessary international support to establish the trust. We are providing innovative solutions to bridge any gaps, and barring any surprises, we do hope that the trust will be fully operational in a little over a year. Thank you, and I look forward to a good discussion.
Thank you, Uma, for that update on where you are on the RST. It sounds very favorable, and belated thank you to you, John, for setting out the vision. I've managed to solve my technical problems and I can be heard now. So thank you to you both. Let's turn now to Governor Cubero. Governor Cubero, during the pandemic, very few middle-income countries borrowed from the IMF. How can the RST be made an attractive and supportive lending instrument for countries like yours?
Thank you very much, Mark, and thank you, the Center for Global Development, Masood, Mark, and everyone who invited me. It's really a pleasure and honor to be here. Greetings to the fellow panelists. And Mark, I would like to perhaps start by making two points. First, why this is needed, and secondly, what sort of design this RST should have to become attractive for the membership of the IMF. And many of the points have been addressed already by John and Uma, but let me focus on a few. First, on the need for resilience and sustainability trust. We know that emerging markets and developing economies already faced significant long-term structural challenges before the pandemic. Chief among them, clearly, the issue of climate change, to which many of them are particularly vulnerable. And that already entails the twin challenges of adaptation and mitigation. But there are all other challenges that are also very significant and that will put significant pressure on public finances. Population aging, for instance, and infrastructure gaps. And infrastructure gaps also are increased by the issue of climate change. But they also, and has been revealed clearly by the pandemic, involve other areas like telecommunications, digitalization, and unfortunately now we know health systems. So all of this requires significant mobilization of resources, because all of these challenges will put very, very significant pressure on public finances, as I mentioned. Already the COP 2016 Accord acknowledged the need to mobilize around $100 billion a year just to address the climate change related needs of EMDEs, emerging market and developing economies. And that is, for instance, not just to finance adaptation to the current challenges, but also mitigation and the cost of transitioning to a low carbon global economy. But we know that the financing gap to actually meet the SDGs is much larger, and it has been estimated by some to be of the order of $400 billion per year between now and 2030. So that is a significant bill that the global economy will have to muster. And all of those pressures we know have been already exacerbated by the pandemic, with the contraction that was brought about by the COVID-related crisis. Revenues plummeted, and there are now very significant levels of debt in many EMDEs. It's estimated that around half of low-income countries and many emerging markets are now in debt distress or at high risk of debt distress. And we know there is a shortfall of long-term financing for MD. So we have significant challenges, need for financing, and at the same time, a shortfall of long-term financing available at favorable conditions for emerging markets and developing economies. So in this sense, this $650 billion SDR allocation really provides a great opportunity to address and tackle these challenges simultaneously, and to add to the fund's existing lending toolkit in an innovative way. And we know also, and this has been highlighted by both John and Uma, that the benefits of the RST would be tremendous in terms of not just growth and wealth, but also even financial stability. So the second question, this to address your question directly, Mark, is how can it be made attractive and supportive, this Resilience and Sustainability Trust Fund? Well, first and obviously, the terms have to be favorable. The terms and conditions will have to involve a favorable design. The first and perhaps the most critical issue is that it has to be a longer term facility with long repayment terms. Certainly much longer than traditional fund lending, 15, 20 years in total, with repayment horizons of over 10 years would be required. And this is because the critical challenges faced by most EMDEs are long-term and structural in nature, as we have already mentioned, and overcoming them will take many years. In fact, and Uma also made this point, the return that will be brought up by the required investments will also take many years in co-op. So it will be necessary to have longer-term repayment terms. And also, this should be cheaper than standard GRA financing from the fund. There should be low or certainly no surcharges. The surcharges are a major barrier actually to fund financing. And if you ask me, Mark, why is it that not many, certainly middle income countries, went for longer term financing from the IMF, say extended fund facilities in the context of this pandemic? The surcharges may be a reason. So in general, we need longer maturities and lower interest rates than the standard GRA financing. The second key point in terms of the design of the facility is that the eligibility has to be broad, and it should certainly involve LICs, but also all MICs, all middle income countries, given the global nature of the problems that are involved. The third point is that access should be high. Given the substantive amount of financing that is required, access should be at least 200% of quota from the perspective of the membership. The fourth point is that for greater effectiveness, this financing has to be tied to a fund facility. This is already something that has been highlighted by both John and Uma. And fifth is that the conditionality that will come along with the fund facility should be focused precisely on the structural nature of the challenges. That requires a longer term arrangement. We're not talking about the maturity of the financing instrument itself, but of the arrangement with the IMF. So conditionality should probably fall over a longer time period than is usually the case, perhaps going beyond the 5 years, but at least 5 years. The structural benchmarks that are set should be focused on key policy priorities regarding the long-term challenges. And in this sense, I like the idea proposed by John here of a national resilience plan. That's kind of the underpinning commitment by the authorities to support the arrangement. Also, the RST supported policy measures should be formulated most likely in collaboration with other multilateral development banks and most specifically with the World Bank. Here we will need to leverage their expertise and ensure that there is complementarity with broader policy and financing strategies for each country. So in this sense, we see collaboration with the World Bank as essential in taking this initiative forward. But we also think that the fund should determine conditionality and should remain at the helm of the governance structure for this facility, including the decision making by the IMF board. And finally, I would like to say that that conditionality should remain parsimonious, even though the challenges are many and long-term in nature. I think structural benchmarks and general conditionality in this in the arrangements that underpin the RST should be parsimonious. So just in closing, I'd like to say that generally what we in the emerging markets and developing economies see as required is very much along the lines of what Uma has already highlighted as being the preliminary proposal by staff. I think that proposal that Uma has summarized this morning is in the right direction. And I would like to thank the IMF staff, the managing director, for the strong support that they are giving to this idea, and Uma particularly because she has been spearheading the efforts within the IMF. Thank you very much, Mark.
Thank you, Governor. And it does sound like there's some common ground there between the vision of John, the practicalities of Uma, and what's going to be needed by middle-income countries. Let's turn to the other essential participant in this equation, the advanced countries. Well, Mikhail, what are the elements of the RST that will attract advanced countries to rechannel their SDRs to it?
Thank you very much, Mark, for your kind invitation. It is an honor to participate to this meeting dedicated to such a topical issue. And France is indeed playing a very active role in this work, in this discussion. But even though the Trésor is co-chairing the G20 working group who discusses IMF-related issues, including SDRs. I will refrain from speaking on behalf of all advanced economies or on behalf of the G20, and I will remain very French in my intervention today. To begin with, I just wanted to say a few words on where we're coming from. The COVID-19 crisis has not only damaged all economies across the world, it has also deepened the economic divergence between countries, and in particular between advanced economies and low-income countries. And this is a key takeaway from the summit on the financing of African economies that France hosted last May. So the acknowledgement of this threat, which has also become a reality, at least partially, has paved the way for bold actions at the international level. I will recall very briefly the initiatives already taken by the G20 and the Paris Club on debt. First, the debt service suspension initiative to deal with emergency liquidity issues, and then the common framework for debt treatments to tackle debt vulnerabilities in a more structural fashion. Among these actions, and in addition to the exceptional measures that were taken by the IFIs have been taken since 2020, the IMF members unanimously supported a new general allocation of SDRs amounting to the equivalent of 650 USD. It was mentioned by several panelists already. It became effective on August 23rd. So this historic allocation was implemented in approximately 3 months only, and it provides much needed liquidity to many countries. And in the meantime, this allocation has provided us with an opportunity to go further in our support to vulnerable countries, namely through SDRs channeling. And in France, it is our view that a quantitative ambition should be set at the G20 level to maximize the benefits of this allocation itself. And reaching a target of 100 billion USD through the allocation and the SDRs channeling seems reasonable and would be a considerable achievement, as we are actively working on it with our partners. In parallel, discussions are moving at a good pace on the technical options to channel SDRs. So we mentioned PRGT. So RST is at the agenda today. There are also options involving multilateral development banks that will need further work in the future. And I would like to thank the IMF for its intensive efforts on this matter. We have really made great progress in a very short period of time. Now, to answer your specific question, I see 3 key elements of the RST that will attract not only advanced countries, as a matter of fact, but also the G20 altogether, and all countries able to do so to channel part of their SDRs. So the 3 are a policy-based element, namely to serve good objectives in countries in need. Second, a design-based element to protect the lenders in the most efficient way. And third, an institutional element to show synergies between the IMF and multilateral development banks. Let me elaborate quickly on each of these elements. So first, setting appropriate objectives for the RST is critical. Today, we have the PRGT, in addition to the GRA and a number of other multilateral funds that help low-income and or middle-income countries face their financing needs. So the RST, to be a success, needs to bring something different to this existing landscape. So the first question is, for whom? In our view, an income-based eligibility criteria obviously makes sense. Its scope could be larger than the PRGT's leaks because many middle-income countries are also facing protracted and prospective balance of payments needs, which are not necessarily captured by the existing toolkit. But this being said, our view in France is that the focus should be on Africa, where more than half countries are low-income countries and where the needs are the most acute. The second question is, for what? There is a wide consensus that the RST can help accelerate reforms to tackle climate change, given the emergency of this issue. It was stressed again by John earlier. In addition, this current crisis has revealed that the pandemic preparedness is a matter of concern for these countries, for us, but for all countries, and therefore require further support from the G20 and from the IFI. So it can be another objective for the RST, as long as it is well coordinated with other initiatives, and we're all aware of WHO's work in this field. And the third question is how. there is a broad consensus among potential lenders that the RST should help address longer term and support more inclusive, resilient, sustainable economic recoveries. It goes together, as stressed by all panelists so far, with longer maturities than the loan served by the PRGT. And we are talking here about a loan of 15 to 20-year maturity. So it makes a real difference. Second point is the design-based element. And that's from a lender's perspective, a potential lender's perspective, I should say. Given the creative feature of the RST, we should ensure a comprehensive and sound risk framework for the lenders. It exists for the PRGT. And so the idea, and Uma stressed it, is to do something very much alike for the RST, even though some specificity might differ. So this framework can be built on multi-layered components, and three in particular: the policy safeguards, stressed by Uma already, the financial buffers. The PRGT has a subsidy account, a reserve account to mitigate the budget risk, the creditor risk. So we are very much looking into a similar architecture, even though, again, we are, as for France, interested in defining and designing the RST with its own characteristics. And then we need a supportive multilateral context. One important issue of the framework is whether we have the broadest participants on board. So it's a matter of burden sharing, and this is also something that will be discussed again this week at the G20 level. But it's a key component for us in the future design of the RST. Two additional comments on the technical features. First, there will be a question on the PCS, the preferred creditor status. We need to find a trade-off between protecting the lender and avoiding overburden of the debt level for many countries who might be eligible to the RST, and it's a concern on both sides from a lender's perspective as well. And second, it was also mentioned earlier, the reserve asset status of the RST is a very important component, maybe not for all countries, but for probably a majority of potential lenders, especially European countries, for legal reasons. So it means having a design and financial engineering that allows liquidity and cashment regime for the future loans of SDRs that will be made to the RST. And then the last key element for us will be in order to have the most attractive RST as we can, is to have a close partnership between IMF and World Bank, but also more broadly with multilateral development banks. Given its characteristic, we also believe in France that other stakeholders might include public development banks. It would make sense when it's about implementing climate change or pandemic preparedness reforms in low-income and some middle-income countries. It's also a very important question to ensure that the RST falls within the IMF mandate, that it also strengthens its catalytic role as stressed by Uma, and also to ensure eventually its efficiency and the value added of the fund compared to the many facilities that already exist within the IFIs and through the multilateral mechanism. And just to sum it up, France is very supportive of the ongoing work to implement the RST in a timely manner. The work is ongoing, and we are hopeful that the annual meetings this week will send a clear political message of support to this work. I'll stop here. Thank you.
Thank you, Miguel, and it's heartening to hear the support that France has, and again that you share many of the same design elements that have been put forward by others. Before we go to the last panelist, I'd like to remind you that we're taking questions from the audience. On Twitter, you can tweet us at CGDev or hashtag CGDTalks. You can email us at events@cgdev.org, or you can use the chat function on your YouTube channel. So finally, let's turn to Meg. Meg, you served as a high-ranking Treasury official. You were on the board of the IMF. What do you think of this idea of the RST as a means of involving the IMF in climate financing and the broader resilience agenda? Can it really be a game changer for the IMF?
Thank you, Mark, and thank you for inviting me to join this illustrious group. It's a real pleasure. And I'm going to speak just my reactions to these ideas based on my many years representing a government and being on the IMF board and hearing many of the concerns of my colleagues as well, not just the creditor side of the fund, but those borrowing from the fund as well. So I very much welcome this idea of coming up with a resiliency and a sustainability trust. And I say that because looking ahead, just based on what we've all gone through on the pandemic, we were not prepared globally, none of us. And it just shows how unprepared we're all going to be for climate change, for many of these other problems that previous speakers have highlighted. So I'm very supportive of the IMF taking this look forward and beginning to figure out how the IMF can be part of helping countries get ready for that, adapt to it. So that is very welcome. I just want to pick up on a few of the comments that others have made and some of my own thoughts just in terms of what I think some of the key issues will be. And then at the end, I'll come back a little bit on where I see the US. And again, this is from the outside, not as a US representative. That was many years ago, or several years ago that I left the fund. But I do think, first of all, John, I like your idea of a national resiliency plan. And the reason for that is, then it's the country itself putting together what it sees as what it needs to deal with all these problems, and then bringing together its partners, because each country is going to be focused on their own problems, what they need to do. And so I like that idea. I don't expect that it's going to be widely adapted, to be honest. I think it will be in pieces, and governments, as they prepare their budgets, are clearly focused on many of these problems. And so in many respects, it'll be there, but I don't think it'll be quite as concrete as you're proposing, which in a way is too bad, because I do think it is a way for a country to trying not so much control, but guide the participation of its international partners. The previous speakers have talked about all the issues that especially need to assure creditors, and I think that's very important. On the surcharges issues, Governor, I was a big supporter of surcharges at the fund, as you can imagine, to get countries to repay. And in fact, it worked. European borrowers repaid, pretty much, I think all of them that borrowed during the Euro crisis, I think repaid early. So surcharges work. In a new trust like this, whether you have surcharges or not, and since we're talking about probably subsidizing interest rates a bit, I think that's fair to debate that. So it still, comes up against the IMF as countries are supposed to repay the IMF when the balance payments improves, even if it's before the final, payment date of that purchase. So I think that's something to be worked out, but I would keep an open mind on the surcharges on this. I do think you need a lot of the protections that Mikhail just went through, and I looked at the list of lenders to the PRGT. And the Central Bank of Brazil is there. So clearly they're going to want the kind of protections you were talking about so that they can get their hands on that loan. I mean, I don't know if it's SDRs or dollars or whatever euros that they lent, but it's going to be very important for them to have that assurance. They can count it as reserves and will be able to get their hands on it. And so I do think it's helpful to look at that list of lenders to the current PRGT, and that'll help give you a sense of what others may need, because I take the point, I totally agree. We do want a broad group of countries channeling their SDRs to a new trust like this. Now, the eligibility of who will be able to draw coming up with a per capita income cutoff is always touchy, as many different organizations have faced, but I completely agree this has to be open to middle income countries. And so what I would see, to be honest, I would think those that are really focused on wanting to channel to the low income countries, I think you might see more going into the PRGT, some of the channeling going into bolstering the PRGT, which then, of course, will take donations to the, will need donations to the subsidy account and other things. But I do think this new trust needs to be open to middle income countries. Lower and middle income countries, those, many of them are stressed. You look at some of the islands in the Caribbean, you look at Central American countries, parts of Asia. I mean, there's plenty of need out there. So I do think it needs to be expanded beyond the low-income countries. Some of the difficulties, I think, are going to be related to the requirement to have a program in parallel, and a sense that conditionality might be a bit of an overload. And I take it that it probably won't be targets, the formal kind of performance criteria as in a regular fund program, but nonetheless, the kinds of conditions that would be set in a new trust, I think are going to be a little difficult to work out when, the key point is you've got to have in view getting the balance of payments back in a sustainable basis. So I think that'll be one of the toughest ones to figure out how you're going to design that, and that may evolve over time. Some of the points others have made, I think, that are really important is bringing in other institutions, working with the development institutions, which, as all of us know, have seen their ups and downs, fund bank collaboration, coordination. So, but there's just no way around the fact that much of what needs to be done, the prime lender, the prime support will come from the World Bank, other institutions focusing on sector loans on projects. And so the IMF focus on the kind of conditions that will help the country manage, its fiscal outlook, the challenges, broadening its resource base, I think will be key. Now, in terms of some of the other things, I think one of the most important things is figuring out how the IMF can help play a constructive role in designing policies that will bring the private sector in. I mean, this is a challenge in the United States and every advanced economy. You're going to regulate everything and tell companies how to, manage this, or are you going to try and develop incentives? Will it be fiscal incentives? That'll cost money then out of budgets in countries. And, that's probably something more for the World Bank and others, but the IMF might be there designing. But we know from the amounts needed that there's just no doubt that we'll need key private sector participation. And that takes confidence, that takes a lot of the structural issues that we spent many years talking about, rule of law, protections. And so that, I think, is something that, top down, bottom up, needs on the part of all the institutions to work together. With that said, I don't see the holders of SDRs, central banks mainly, but also others, wanting to channel their SDRs to the MDBs. I think they'll want to keep them at the IMF, whether it's PRGT or a new RST. I think that's important. And then just turning briefly to where the US is on this. And again, I'm an outsider, so this is just my understanding. But the US has in its budget, new budget request, requested Congress to authorize and appropriate $102 million. Now, that sounds like a small amount of money, but it's geared towards covering the credit risk of a loan, SDR loan to the IMF, whether it's a loan to the PRGT or a loan to a new facility. And that could be perhaps up to $15 billion worth. So it's to cover the credit risk. I would argue mightily, and I have here in town, that the credit risk for the United States of lending to the IMF is virtually zero. So I haven't always won that argument, but I will keep saying that. And then some of that 102 million might also be available to then donate, an outright donation to a subsidy account, because those have to be donations. As you all know, there's no budget in place yet for the United States. So we still need Congress in the United States to approve this. And of course, Congress, when it looks at different laws coming up with a budget, can add things to it. So that's what I would really hope, that Congress does not decide to add on any additional requirements that the US government would have to meet to be able to participate in this channeling exercise. Secretary Yellen has been very supportive. The fact that the US supported in such a large allocation this year, I think is pretty impressive, something that I've been urging for over a year at the start of the pandemic. I think it's very welcome. So I think the intent is there. It's going to take a lot of hard work still yet with Congress to get this done. And then, as Uma was telling us, within the IMF to reach agreement. But I'm looking to the G20 to have a very strong positive statement, the IMFC this week, and for different press conferences to really urge all of us to be part of the solution. So in that respect, I do think it's a game changer. I do welcome this forward look. I don't think it's going to be a huge amount of lending to begin with because of all the different things that have to come together for a country. But to have something like this in place, and as I know from my many years at the IMF, we can evolve facilities, we can broaden them, we can adapt to changing circumstances. And that's what the IMF board has been willing to do when it's needed. So I expect that to continue, and I look forward to much more work and a good outcome sometime this next year. Thank you.
Thank you, Meg. Thanks. It's a nice summary of what's gone before. Let me again remind the audience that we're taking questions either by Twitter @CGDev, by email events@cgdev.org, or on the YouTube chat function. So don't be bashful. Please ask your questions. We've gotten a couple so far, and they're right now revolving around conditionality. And clearly, borrowing countries want the least amount of conditionality possible. They would like free reign with their resources. But one questioner says, look, you're not only going to put conditions on the RST, you're going to couple that with a fund program that has its own conditions. Presumably each has a different concept of balance of payments need. What prevents that from becoming conditionality overload, if you will, on these countries that already the countries are suffering under what many view as an excess of conditions. Uma, I'll throw that to you first, but I'm sure others will have reactions. What do you say to that?
Sure. It's a fair question. And, this is something that we have also been hearing from discussions with other stakeholders. And, for those who are familiar with the IMF's guidelines for conditionality, parsimony and macrocriticality are important components of IMF conditionality. So the idea is definitely not to overload a country. And this is where, capacity constraints need to be taken into consideration. And where countries do have capacity constraints in our regular programs, we provide the necessary capacity development, or technical assistance that is necessary to bring capacity to a country also. So in the context of IMF lending, we also provide the necessary capacity development resources that a country might need in order to scale up its capacity. So we would envisage that we would be able to provide that in the context of the RST also. But that said, we would, the idea would not be to load up a country with conditionality. The idea would be to identify, for the duration of the program, what would be the policy priorities that the country can realistically tackle? What are the policy priorities that the country has the capacity to implement? And what would be the ways in which we can sort of design that so that the country is able to implement rather than falling behind in its reforms? So, these are issues that we have been thinking about, and in the context of collaboration with the other institutions, I think we would have to also bring in what they are doing, what versus what we are doing, etc., so that there is complementarity and we are not overloading the country amongst various institutions to the point where they are not able to deliver what they are committed to deliver. So this is a fair question, and this is something that we do have to keep in mind. But on the concurrent UCT or the IMF program that would be needed to request an RST also, the purposes of the UCT program, what we call the upper credit tranche program, it would have its own objectives based on the macro stability needs of a country, and that may be a light touch or it may be a heavy touch depending on what the country needs. So that will have its own sort of criteria, and then the RST would have its own. But on balance, we do expect that we would take the capacity needs of the country into consideration and where it is in terms of ability to implement. And if a country, as we all know, and we have seen this repeatedly, if a country does not own the programs and it does not own the reforms, it will not be successful. So that engagement with the country authorities to see what is doable or not will be a critical factor in how we design these programs. let me stop there. Thank you.
Thanks, Uma. John, you had said in your initial intervention that you didn't see the necessary need for having both a regular program and an RST. You thought an RST program could stand on its own. What do you think of this idea of requiring a UCT program in order to get the RST?
Well, I think there are several considerations. Clearly, many emerging market countries and developing and low-income developing countries have other balance of payments problems than these prospective ones connected with building resilience and mitigation and adaptation aspects of it. So to the extent that they do have policy-induced balance of payments need or other aspects, then it's clearly appropriate that there should be a parallel arrangement under usual IMF lending or the PRGT, whichever it would be. That I can see. But logically, if a country is in good macro shape, yes, they may come for a precautionary arrangement under certain circumstances. I mean, that may be part of the idea. But I do think it has to be looked at in a broader perspective. If you look at what you're trying to do here, which is to nudge countries to move in the direction of implementing extraordinarily difficult policy changes to deal with the challenges ahead, there are risks in not helping them at the margin in doing one or two good things and choosing one or two things and getting on with it. By putting too many constraints on this financing, which is frankly trivial in the whole overall scheme of what's needed with this massive structural change in the world economy, then there's a danger that you end up with a much worse outcome, where the situation of many economies will be much worse. So I think from the fund's sort of risk assessment of where it thinks about placing the conditionality nexus, I do think that fairly low conditionality, not meaning that it's nothing, but it's one or two issues which the country can do, which is substantive, doesn't get too much into the structural issues which are critical for the success of this, but would be mainly led by other institutions. I think that's important. The one other aspect on conditionality, which coming back to one point that the governor made, on terms of the access, I mean, if I the back of the envelope calculations, if we're talking of the area of $50 billion for this trust, and we don't know where it'll end up, but of the 100 billion or so that have been penciled in to be spread amongst different initiatives, something of that order, but we don't know what it'll be. And then you spread it around the present way that access is determined at the IMF through the quota calculations, you would get actually quite low access limits if you include any number of middle income countries. And so there is an issue there as to whether there's a differential access for low income and middle income countries. But in any case, these amounts are not large. And when the fund is sitting on the so-called trillion of lending capacity under the regular facilities, this is not a large amount of money. So I don't see practically how there could be very large access under the trust unless something changes very dramatically. And therefore you can imagine that many emerging market economies, if they're going to get IMF financing, will have to come to use some of the other facilities in some kind of blend. But that's a separate motivation for doing so from the one that I think we were discussing earlier.
Governor, on this conditionality question, I mean, do you see you said you supported having both programs at once. Do you see a country like yours being able to manage, if you will, two simultaneous programs from the IMF that would have the reach of these particular programs?
Thank you, Mark. So you know, the way I see it is a relatively light touch. Just borrowing Uma's term, UCT or standard fund arrangement with the conditionality of the RST imposed on it, because as we have been saying, the whole point of this is to get the funding to where it is most needed to address long-term global challenges, particularly in low-income and middle-income countries. So we need to get the incentives right on both parts. It's a dance here. So I fully agree that creditors' interests have to be addressed and met, and for this, you know, the existence of a fund arrangement is absolutely essential to reduce credit risk the preferred creditor status is absolutely essential. So we agree with that, particularly because lenders will be central banks, and they need to have these reserves, and that also requires the encashability mechanism to be in place. So all of these safeguards, these three in particular, the existence of a fund arrangement, the preferred creditor status, and encashability mechanisms need to be in place to attract the donor funding, and that needs to be in place in order to get the financing required for addressing the long-term structural needs. But I would think that arrangement, that is one key condition, the UCT, or the standard fund arrangement, should be relatively light touch, in the sense that it shouldn't double up the conditionality and overburden the recipient country with a lot of conditions, and particularly to the extent possible, that the conditionality should be aligned to the long-term challenges that the RST wouldn't entail. Let me just very quickly refer to two issues that have been mentioned here. One is on surcharges, and I fully agree with Meg that surcharges are critical to align incentives for countries, member countries, to repay the fund as soon as possible. These surcharges are critical in making sure that countries repay the fund as soon as they regain market access. But that is predicated on the assumption that countries have a temporary loss of market access. For that type of problem, of course, surcharges are in order. Now, when we're looking at longer-term structural challenges that are not occurring because of a temporary loss of market access, the surcharges may lose some of the rationale. And this is why I think we should probably rethink surcharges in the context of this RST. That is one point. The other is on access, and John has just made the point. I absolutely agree that given the funding likely to go from SDR, the SDR allocation to the RST, we wouldn't be able to get a very high market, a very high access in terms of quotas. But I think a way to overcome the problem is certainly to place absolute caps on borrowing. So for large countries, of course, there should be a cap in terms of how much they can borrow, so that even though it may lower their access as a percent of quota, it will ensure that all countries have some access, to significant access in absolute terms, to the facility. So I think that's the way to resolve this problem, John. And thank you, Mark.
Thank you. John's comment on access and on the amounts of money available prompted another question, which is, it seems to at least one questioner that the advanced countries are being quite stingy, that in fact these SDRs, about 400 million, I guess, have gone to the advanced countries, a large chunk. They really don't need them. They have plenty of reserves and plenty of liquidity. So why is it that they're only putting up 100 billion, not 100 billion, rather than 400 billion? I mean, if you look at the needs of low-income countries even before the pandemic hit the world, they were huge, and there was a shortage of financing. And so now you have this 650 billion worth of new financing sitting in the world, most of which went to advanced countries. It seems that they should be putting up more than this. Mikhail, I'll put you on the spot and see what your reaction to that comment is.
It's both a good question and a tricky one. So I'm not responsible for setting the political objectives, but you've heard rightly, including in my intervention, that the target that is being set by some countries, it was the case during the summit in May, but also at the G7 summit in June, is around 100 billion target. I think it gives some kind of political ambition. That's the first idea. Out of 650 billion USD, if we can collect already 100 billion, it's already a big step forward. Then, from a creditor perspective, you have to take into consideration the consequences of lending SDRs, including and especially through the IMF. It doesn't come without taking some risks. So we've discussed the creditor risk. There is the question of ensuring the loans out of the SDRs are provided at the most concessional rate possible. So that also impacts the financial contribution some countries who lend their SDRs might need also to provide. So it has budgetary consequences, and all this together has to be taken into account when we design a scale up of the PRGT, and when we think about creating a new trust fund within the IMF. That's considerations for lenders. For most of them, this is clear. In Europe, this is the case for France. And in addition to this, we also are cautious about first the absorption capacity. That's a matter and a concern shared by many in this discussion, to be sure that what we're putting into this SDRs pool is at the end used by eligible countries. And then that, again, it's not overburdening their debt level, and in many cases the level of debt is already high. So it's also our responsibility to ensure that loans are not the only answer to the financing needs met by these low income and middle income countries. That's how I would answer your question.
Thank you. The next question is obviously from an old IMF hand. I'm not sure who it is out there. I don't have any names, but the question is something along the lines of, we tried this interinstitutional cooperation when we were trying to fight poverty with the old Poverty Reduction Growth Facility and the PRSP. And now it seems like you're going to reinvent this, but for climate. What's going to make it work this time? The imperative is the same. Well, perhaps it's stronger, perhaps not. But Meg, do you have insights? You've been with these institutions for a long time and you know how they work. How is this cooperation going to take place? What's it going to take to get it to work?
It's going to take a lot of hard work. And I think you've heard from all the speakers here what these issues are. And Uma's going to be right in the thick of it and trying to bring them all along. But it is really hard because SDRs are such a strange asset. You know, holders of SDRs have the right to try and, to convert them into a foreign currency, a usable currency, with another holder of SDRs. And all this is run through the IMF. It's not something you just go out and spend easily. And as several of us have discussed, these are held by central banks. Central banks are not your typical donor agency. So even for them to lend something like this is new to many of them. And I was surprised it was only 11 central banks that have lent to the PRGT. I thought it would have been more, to be honest. And some of them, and it's also some governments too. So they're doing it out of their treasuries, I presume. I was surprised that it wasn't, this is on the IMF website, a bigger list of countries. I mean, the US has its own issues getting permission to do things like this, but most other countries don't, yet there still hasn't been a huge volume of this type of lending to the PRGT. So I think this is part of the difficulty. It's a different kind of an asset. And in the end, to make it work and to keep interest rates low, you're also going to need the subsidies. And this is what Mikhail just pointed out. Then it does come out of budgets. And, that's an issue for the US, but it's also an issue for other countries too. So it gets very complicated within each country. And just as an example, the SDRs that have already been allocated, I've just been seeing press reports recently of how within countries, for governments to get their hands on SDRs, they have to go and ask their central bank. I mean, I saw something on Nigeria. It's like, okay, we want to use some of these SDRs to help with our budget in this difficult time period. And so they have to go work something out with their central bank. They can't just go and use them. And this is, of course, for countries with a, somewhat, degree of independence for their central bank. So I think this is part of the complication, but I still think this is a really good beginning. And sometimes it takes a while for things to take off. And it may be possible that over time, especially if the IMF succeeds in working well with other institutions, other organizations, and designing good policies that help build the ability of countries to manage a lot of this, that it might turn into something bigger, but let's not give up hope yet. Let's give it a try. And, there's a lot of goodwill out there, and I think we should work with it within the G20, the G7, the broader group. So don't lose that.
John, you want to come in?
Yes, on this issue of collaboration with the bank and the fund, I mean, obviously there's a long history to this. We've all been involved in various ways. I do think that there will have to be a look at, you know, what worked well in previous cases of cooperation and what didn't and why in structuring the way the cooperation goes on. In my view, the PRSP, which was a document that was put together for the ESAF as it was in the PRGT, was too cumbersome a process and tied up far too much resources thinking with the issues to get those documents out. And it wasn't clear to me that they really added very much at the end. But there are other examples which I think are more successful. I think the financial sector assessment program, which was joint as a result of the Asia financial crisis, which did involve trying to meld very different cultures of the two institutions in order to come up with what was needed on both sides of the street in order to fulfill their responsibilities, is perhaps a little better model of how things could be done in this case. But it's nonetheless true that you have to work together on these issues, and it's going to require a lot of goodwill to do so. So that I would leave it at that.
Mikhail, what has to be done from the shareholder side to make sure these institutions work together? How do you see, if you will, the board dynamics working on this?
Well, first things is for the IMF and the MGBs, World Bank in particular, to work together from now, not to wait too long. And it's already the case. Uma stressed the point that there have been ongoing discussion between the IFIs, and that's key, so that we don't lose time in the coming month. And that's something that G20 is very much in favor of. So from the design and technical, the definition of the technical characteristic, it must be a cooperation as from now. And then in the implementation phase, our view is that the NGBs will provide value. They have an expertise. And so we expect on the field to have discussion in countries between IMF staff, World Bank staff, but it has to be also in the headquarters. So this is how we envisage. And then to have reporting from them. The G20 is also a forum where the IMF and the World Bank work together in good coordination on many different aspects. It's true on debt treatment. It can be true on SDRs channeling. So that's also an area where we will look forward to the joint reporting from IMF, World Bank, and MGBs as far as the RST is concerned.
Thank you. One last question. Again, it seems to be from an insider who understands the details of this. The person asked, the reserve account for the PRGT covers roughly 30%, if he correct, of the loans outstanding. Are you thinking about the same size reserve account for the RST? On the one hand, maybe it should be smaller because nobody ever draws the reserve account anyways, but maybe it should be larger because you're going to middle income countries that perhaps are more market risky. What are you thinking? Because these are hard resources that have to come in. These aren't SDRs that have to come in. So they're, as Mikhail said, they're true budgetary resources. Uma, do you want to start with that one, and then maybe others have something to say?
Sure. I mean, this is a super technical question, and we do have financial simulations that we are undertaking to, try out various scenarios on how this might work. So we are still in those stages, and it is, still early stages to be able to have a clear answer. But what I would say is that we do envisage a reserve account, and what the size is, we have simulations and scenarios for what it might look like. We would have to converge on an approach. But for the RST, we are also thinking of a second layer as a financial buffer, which is the deposit account. So, so if we do go forward with the deposit account where some countries are able to deposit some amount of their SDRs, which can be used for investment to generate income in the deposit account, for instance, it is possible then that you may not need as large a reserve account. So, if you go down that path, then there could be some trade-off or sort of rebalancing there. on the size of the reserve account. But this is still work in progress, and we are thinking about what would be the right structure for the RST. The objective would indeed be that the financial buffers would provide the necessary credit risk protection, but whether we layer it differently and how exactly that might play out is still, something that we are working out, and the precise numbers that will go each place is, we will come up with that hopefully in the coming weeks, months, but that's along the lines that we are thinking.
Anybody else want to intervene on that? John?
I mean, although it's a modest additional effort, I mean, given the global public good element of a lot of what's thought of here, it would seem appropriate not to charge the new trust with the administrative costs, which the PRGT used to do, so that the fund itself would charge the trust for the administrative costs of running it. And that would be a relatively small contribution from the IMF proper, but would seem to be entirely appropriate, and it would help a little bit at the margin for this issue.
One question that's not quite related to the RST, but interesting for the governor. Governor, as a governor now of the central bank, how are you thinking of using the SDR allocation, the straight allocation that you've got in Costa Rica for your country?
Well, each country has its own institutional arrangements. In the case of Costa Rica, there is an absolute ban on central bank lending to the government. So we have to preserve the SDR allocation in the central bank coffers. But that is all very well, because we need the additional reserves. So that at this point in time, precisely, many countries, low income and emerging markets like Costa Rica, need the boost to international reserves. So the SDR allocation was very much welcome, and we'll keep it as international reserves of the central bank coffers.
Thank you.
Other countries have different arrangements, as I mentioned, and I know some other countries are already setting up agreements with the government to pass on the resources, but that is not the case of Costa Rica. As I mentioned, we do have the right ban. Yeah.
We've been tracking a bit too at CGD, and we see a wide variety of uses of SDRs. In often cases, if not the SDR, they use the other foreign exchange that's freed up because of the presence of SDRs to support the government. That's been done in a couple of cases. So you do see more latitude among many countries. Okay, we're just about out of time. I thought maybe I'd go through to each one of the speakers and give you 1 or 2 minutes for, if you will, a concluding remark. Why don't we go in the same order that we started in? John, you want to say what you took away from this conversation?
Yes, well, I took away that it seems to be things moving in the right direction, but bold action is clearly needed in the very short period ahead. I would emphasize a couple of points. First of all, it really is the political opportunity with these meetings coming up, and the chair of them moving from Italy to Indonesia in one case, with the UK having the COP chairmanship for the period ahead. These are important opportunities to get something done. The second point I'd make is that there's the way that change occurs at the IMF, as in many other institutions. You start off with something and make sure it works and then build on it. So to get back to Meg's point about these policy statements, these NRPs as I call them, I mean, the way that traditionally the fund has gone about introducing something like that is to get a volunteer pilot program to work out what they mean, who would contribute to them, and seeing if they work. And if they have use, if they find that they are useful to help the country and the IMF in fulfilling its function, then it starts to take on a momentum of itself. And many of the initiatives that have taken place over the last 20 years have started off as voluntary understandings, which then get embedded more deeply into the work. But finally, the issue that this really is a very important topic, both on climate change and biodiversity and desertification, which are the ones I would highlight. I wouldn't rule out other aspects of resilience. But the present structure of the world economy is simply unsustainable under either the scenario in which the world suddenly turns around and meets its aspirations for climate mitigation, or if it doesn't. And so the fund and the bank are going to be deeply imbued in this for the next generation. Each mission team, as a way it's thought, each country team, the board, and all the member countries. So this is something they should get on with.
Thank you, John. Uma.
Thank you. I want to thank CGD again for this event, and I think it is very helpful for us to hear views and ideas and have this exchange of views in public fora. We are very excited about this opportunity. The 650 billion general allocation of SDRs was a historic one. And I think what it presents is also a historic opportunity to be able to magnify the effect of that allocation so that the countries most in need are able to benefit from that allocation. So that's the journey that we are in right now. And we do see that this third leg in the toolkit, we have the GRA, the PRGT, and now the RST potentially, will add a lot of complementarity to the existing toolkit with the long-term component that we are bringing, the longer-term lending, the lower term structure, etc. So we are hopeful that the encouragement and the support that we have received so far will continue. I would also add that designing a trust like this from scratch not only takes time, but we have to build consensus both from the borrower side and from the lender side. And that does involve trade-offs. So it may not be what borrowers would want 100%, and it may not be what the creditors may want 100%. We have to find a way that works for everybody. And that is what we are striving to get to. And we have made great progress. Stakeholder consultations have been great, including with Governor Rodrigo, with whom we have had discussions on hearing views from potential borrowers and potential lenders. So once again, we are encouraged, we thank you, and we are looking forward to taking it to the finish line as soon as we can. Thank you.
Thank you, Governor.
Thank you very much, Mark. I would just like to highlight the convergence, the strong convergence there seems to be in the different ideas we've all put forward. And that is reassuring. I mean, I think we all agree this should be a facility in long-term favorable conditions tied to a fund arrangement with parsimonious macrocritical conditionality, and that there should be strong collaboration with the World Bank and other regional development banks, but at the same time keeping the governance strictly in the fund's governance. I think there should be also broader visibility. All of these ideas have been already put on the table, and I think there's strong convergence, at least as far as the panelists here are concerned. And I think that's really reassuring. Going forward, what is also reassuring is the fact that, as I mentioned, there is a lot of goodwill out there. And I think this annual meetings will provide a critical opportunity to actually take this forward, and hopefully we'll see this panning out sooner rather than later. I would like to thank the CGD for the opportunity to speak here, and it was really a pleasure seeing all of you. I would also like to thank the Managing Director, Kristalina Georgieva, and the fund staff for pushing this ahead. They have been doing a tremendous job because it's a very complex design, and it takes many different areas of the fund to get involved. So my thanks to them for all the hard work, in particular to Uma, who has been leading this effort. Thank you very much, Mark.
Thank you, Governor. Mikhail, I turn to you, and I would note, I think you're the only one on this panel who hasn't been somehow connected with the IMF. So perhaps you can take a bit of an independent view from us old IMF hands too.
Independent for sure, but still as a French official. Just to be short, I think we have a political momentum on SDRs channeling, and in the meantime, we hear high expectations from many countries. So to be very short, this week in Washington DC, we hope new contribution to the PRGT will be secured, and France will take its part. And then on the RST, we support a clear political message on the key principle of this new fund. It will help technical work to accelerate, and going forward, hopefully the RST will be an effective tool as early as next year. That's what we are looking for. Thank you.
Excellent. Thank you, Mikhail. Meg.
Thank you, Mark, and thanks for this opportunity. I would agree the political momentum is there. So I expect by sometime next year, as Uma was talking about, something will be in place. Two key things, besides all the details that need to be worked out, coming back to where John started us off, the country's own plan has to be at the center. They're the ones that are experiencing whatever's coming at them, whatever they know will be happening or don't know and need to prepare for. So it's got to be focused on the country itself and how they put together their policy package with all the different considerations they've got in their country. And equally important is the fund working with the other institutions, because as each one of us has pointed out, the amounts needed for dealing with a lot of these issues are huge. The IMF can't do it alone. Need to work cooperatively, bring them together. And you've got to realize the country itself can't always do it. It needs the institutions themselves making that extra effort to work with each other at the top, at the middle, at the country team level. It really is very important that the IMF succeed in making that work. Thank you.
Thank you, Meg. Thank you to all the panelists. I think I want to go back to my initial comments, which is there really is a three-step process. We've got the allocation, we need to do the recycling, and then we need to get the money out to the countries. And I think we have the elements of those last two steps in this conversation. As all have said, there are a lot of details to be worked out. They're complicated details, particularly for insiders, but I think with the right political will and the push from shareholders and others, we can get it done, or the fund can get it done. So good luck to Uma and her colleagues, and we will all be cheering you on from the side and giving you our criticisms along the way as well. So you can be sure that we'll participate fully in this process. Thank you very much again for your participation. Thank you to the audience for your questions and your patient listening. And please look at future CGD events, particularly on SDR recycling. I think we will have some more in the coming months. Take care and have a good day. Goodbye.